Good afternoon. Welcome, everybody. For those joining us virtually, thank you so much. For those of you in person, thank you so much for showing up. My name is Steve Maldonado, the Director of Syndication Solutions here at NuView Trust, and I'm so excited to be joining you this afternoon to talk about the wonderful world of passive investing, more specifically passive investing into real estate and real estate multifamily. Now, before we get started, I want to give you guys a quick disclaimer. NuView Trust is a passive IRA custodian. We custody IRAs, ESAs, and 401ks for the purpose of alternative asset investing. We do not employ CPAs, attorneys, financial advisors, or anybody that can provide you that level of advice. We can advise you on specific strategies related to your self-directed retirement account, but if you do need any more specific advice, please reach out to those entities. Now, before we get started on our presentation in passive investing, I think it's important to understand what a self-directed IRA is. More specifically, what a self-directed retirement account is, because there's such a variety of accounts that we custody and allow our clients to invest through. Now, self-direction is simply just a marketing term. It refers to the account holder's ability to direct all of the activity within their account. And this is truly the beauty and the power of these accounts. Every day, I wake up getting to empower our investors to invest in what they know. Not what their advisor tells them to do, not what the market tells them to do, not what Google or Yahoo tells them to do, what they know best. Empowering them to make their own decisions while also lowering the negative burden of taxes. So a self-directed IRA is just like any other IRA, except with this, you can invest into alternative assets like real estate, cryptocurrency, precious metals, you name it. Now, there's some advantages to investing through a self-directed IRA versus a standard IRA with Schwab, Fidelity, or whatever brokerage you might work with. A self-directed IRA, as I explained, allows you to invest into alternative assets, those securities outside of the stock market, which allows for diversification in your portfolio. Now, for any investors that are savvy, they know diversification is key. Making sure that all of your eggs are not in one basket is super critical to making sure your portfolio is healthy and stable. Tax savings. Depending on the setup of your account, your investments within a self-directed retirement account grow tax-free or tax-deferred. Finally, investing in what you know best. As I mentioned, the true power, the true beauty of these accounts comes from investing in what you know best. Let's kind of break that down a little bit. I had a client of ours call us up about a year ago. He said, Steve, I've been working for my company for the last 15 years. They've been really good to me. Been able to squirrel away a hefty sum in my 401k, but it's currently underperforming. Leaving my current employer. What possibilities do I have with this money? Well, I started asking, hey, what are you interested in? What do you want to invest in? Hey, Steve, well, I really wanted to learn a little bit more about real estate investing and what I can do to put those retirement funds to work in real estate. What I told him is, that's great. Now define it a little bit more. And all that means is that, real estate, many people attribute to single family homes, but there's so much variety in real estate that we're just not exposed to. Tax liens, foreclosures, build to rent, the subsectors of commercial properties like industrial, self-storage, multifamily, right? You name it. Again, what's super exciting about these accounts is being able to pick your investment choice, being able to not only view this menu of options, but curate your own menu of options and then make a selection based on your risk tolerance, etc. So diversification, tax savings, and being able to invest in what you know are just some of the advantages of using a self-directed retirement account. Now we're here today to talk about passive investing. Let's define passive investing. Passive investing is investing in a project or opportunity without the actual active involvement of day-to-day management. This can be through real estate or other forms of private equity, but today we're here to talk about real estate and more specifically multifamily. Now, There are several advantages of passive real estate investing. I'm here to just mention a few. I think when most investors think of real estate, they think, oh, I'm going to build this, I'm going to buy this, and we're going to find a tenant, put them in, and rent it. And that's fundamentally what it is, right? If you're looking for cash flow, steady cash flow, then real estate is the way to go. Passive investing into real estate allows you to buy into a portion of a real estate opportunity without having to actually manage the tenant, the repairs, you name it. So moving on to our second point here, the day-to-day property management. It's not your responsibility. You may have heard of toilets and tenants. Those are the two biggest headaches in any active real estate investor's portfolio. Actively having to manage the tenant, all of their expectations, their wants, desires, and needs, while also keeping up with repairs, make-readies, you name it. It's a hassle. Nobody wants to deal with it. And for the investors that we work with that have more money than time, passive real estate investing allows them to make these investments into real estate while not giving up that time in the day-to-day management. Now, as we mentioned, investing through a self-directed retirement account provides unique tax advantages, but investing into real estate also provides some unique tax advantages as well. Skipped ahead here for a second, sorry about that. It provides some specific tax advantages as well, including depreciations, appreciation in value of assets, and then other real estate tax incentives. So moving on to multifamily as an ideal passive investment. As I mentioned, there's multiple forms of real estate investing. When we talk about real estate investing, we may talk about, again, tax liens, foreclosures, build to rents, you name it. In my world, I get to connect with multifamily operators, general partners, and fund managers. We'll get to this in a second. But these are individuals raising capital for a variety of real estate opportunities. They act as the active investor, giving opportunity for passive partners to come in, put their money into the deal without having to actively manage the day-to-day. Now, if you guys have been keeping up with the trends in real estate, you may know that multifamily has been a super hot asset class for the last few years. Now, the economy has cooled off a little bit, and that's left people a little bit speculative of where we're going as we move forward in 2023. Now, I'm not an economist, okay? But I do spend most of my day talking to multifamily syndicators or people purchasing real estate. So I've compiled a few notes here to kind of talk about where we're at going into the rest of 2023. Now, although below all-time highs, occupancy rates are still falling between 93 and 95%, and this is indicating a generally healthy market. The other opportunity that exists is the fact that the US is underhoused by more than 6.5 million homes, despite there being over 1 million homes in the construction pipeline. This leaves a tremendous amount of opportunity on the table for any real estate investor, but especially those passive investors. Now, you may have heard of hot markets: Orlando, Tampa, Phoenix, Raleigh, you name it, okay? Those markets are categorized by high development concentration, and that's simply put factors on fundamentals, pressure on fundamentals. Now, that said, those areas have good demographics, those areas have good in-migration trends. Heck, 1,800 people move to Florida every day. So despite the high development concentration, there's still a lot of opportunity that exists in those areas. So I don't think investors need to be scared by that either. Furthermore, although slightly lower than they have been, existing home prices are still not affordable for many Americans. The affordable housing crisis has developed and snowballed into quite a disastrous place. And that's why, again, we're here to present the multifamily opportunities. Multifamily opportunities provide flexible living situations, rentable situations, and affordable situations. So again, home prices are not coming off of all-time highs by too much. Furthermore, rising borrowing costs have increased mortgage rates. This makes housing less affordable compared to renting. Overall, fundamentals in multifamily, though, still remain sound, and believe that this is still a good opportunity for investors that are looking to use their money passively and invest in real estate. Moving on to demand and stability, two of the most important considerations when really making any investment. How stable is my investment? What is the demand for this particular asset class? Well, there's a strong demand for rental properties due to several factors: lifestyle preferences, flexibility, and affordability, to name a few. Rental housing tends to be more resilient during economic downturns, providing stability in multifamily. As we mentioned, the US is currently underhoused by 6.5 million homes. This creates a supply-demand imbalance that supports the real estate market stability. In addition, renting, as I mentioned, offers flexibility for tenants, allowing them to adapt to changing circumstances. If COVID has taught us anything, the need to adapt, the need to change on a dime, can be more necessary than we ever thought. Working from home, you name it, has led people to live a totally different lifestyle. And as tenants become younger, they change the perception of what is needed, and what is needed and what's wanted by these tenants is flexibility. Rental housing, despite the other factors in the economy, has seen consistent growth, driven by factors such as population growth. Again, I mentioned Florida, just because we're here in sunny Central Florida. 1,800 people move here every day. Furthermore, urbanization and shifting cultural attitudes have all contributed to this consistent growth. Now, to talk about multifamily, at this point, you're incredibly excited to learn more about multifamily and some of the benefits to you. Multifamily has many benefits, but I broke them down into these three main categories here: scalability and economies of scale. Economies of scale allows passive investors to invest into a single opportunity, yet benefit from the rewards of multiple rental units. Economies of scale also lead to cost efficiencies in property management, maintenance, and other professional aspects of managing real estate assets. Next, we talked about active versus passive, and passive meaning that you are not involved in the day-to-day operation of your real estate investment. As we talked about toilets and tenants, both of those fall under what we call as property management. Now in multifamily, again, we talked about this, and more so passive investing provides you the opportunity to invest into a real estate opportunity and not have to worry about everything that a professional property manager would. You can leverage those professionals, their teams, their expertise to run a more efficient and cost-effective operations. They handle the day-to-day operations, the tenant management, the property maintenance, and other responsibilities, freeing up your time and effort to go out and find new opportunities and make money for yourselves. Finally, multifamily syndications or multifamily investing allows the mitigation of risk through diversification. As we talked about, diversification in any portfolio is important to maintaining a healthy and balanced growth and return on that portfolio. Mitigating risk through diversification in multifamily means spreading the risk over multiple properties in different areas. This will help you reduce the impact of vacancies, economic fluctuations, or other risks on investment returns, overall enhancing your investment portfolio. Now, at this point, you're probably wondering, well, how do I get involved in multifamily? I can't simply go out buy this apartment complex because it's $20 million, $30 million. And I'm just an average Joe. I don't have $20, $30 million. Well, let me introduce you to the world of syndication. As I mentioned, I'm the Director of Syndication Solutions here at NuView Trust. And to kind of break that down a little bit more, my team connects with those active investors who want to fundamentally change the lives of their investors. These active investors go out, source deals, underwrite them to make sure they work, and go out and raise capital to purchase these assets, cash flow them, add value, refinance them, exit, however they decide. And we'll break it down here in just a second. The syndication process is fairly simple. Now, before we get into the actual process, I just kind of want to break down what a syndication is. A syndication is a group of investors pooling their money for a common investment purpose. Today, we'll apply it to real estate, multifamily, industrial, commercial, you name it. But syndications, in essence, again, are those investors pooling their money together for a common investment purpose. In real estate, the general structure of this looks like this. There are two entities, the general partner and the limited partner. Let me slow down. Most syndications are set up as a limited partnership. The limited partnership is formed like an LLC or an LP with the intent to purchase a property. The two members of that limited partnership are the general partners, or the active investors, and the limited partners, the passive investors. Today we'll call them GPs and LPs, general partner and limited partner. In a syndication structure, a general partner, the GP, goes out and identifies a property they feel they can add value to or produce significant returns with. They underwrite the deal, they make sure that it works for themselves, and they make sure that there's enough wiggle room to bring in other partners. Now, these syndicators, although they see the value in those opportunities, don't have the 10, 20, $30 million that it takes to acquire it. So just like you would, if you didn't have enough money to purchase that single family home, you'd go to a bank, you'd acquire funding, and you'd simply finance the rest, right? Well, syndicators go out, they secure financing, and they make it work on the numbers. That said, there's still a down payment to pay, right? So where do we come up with the $5 million, the $10 million down payment when we have zero in our bank? The answer is other people's money. So the general partners, while most of them will put in a portion of their own money, will go out and raise the majority of those funds from what they call limited partners. Now, those limited partners are meant to be passive investors, simply putting their money into this deal and collecting dividends and returns upon divesting that asset or exit of the investment. The general partners, again, are responsible for actively managing those deals. They do all of the underwriting, deal sourcing, asset managing, property management, you name it. But this is a syndication structure, plain and simple. Nothing too complicated about it. So let's talk about the role of the syndicator in passive investing. Well, the first role of a syndicator is to go find a deal. Deal sourcing, okay? Syndicators find investment opportunities that match passive investors' goals. So when they go out, they typically will pool, right? A group, focus group, let's call them, of passive investors. We're trying to determine investment criteria. We're trying to determine where our visions may align. The syndicator then goes out, starts taking a look off market, on market, you name it, at deals all over the place until they find a deal they think may be good. Once they find a deal that may be good, they move on to the due diligence process, where syndicators then thoroughly research and assess the potential investment and evaluate its viability and risks. Once they've done their due diligence, they will work to actually structure the investment. And again, without getting too granular, there are multiple syndication structures, the actual preferred returns, the waterfalls, all of that needs to be decided well before pitching this deal to any potential investors. So the syndicator, once they've found the deal, once they've done their due diligence, before they start raising capital, will go and structure the investment. And typically they do this with an attorney. Again, you guys are not here to learn about being syndicators, more so how to put your money into passive multifamily investments. But they will go, they will structure the deal, they'll make sure they have all of the legal requirements matched before getting in touch with you. Then those syndicators will go out and raise capital. They will present you with the opportunity. They will present you with the subscription agreement, the PPM, and give you the opportunity to invest passively into their deal. Once the asset is acquired, we talked about some of the beauty of passive investing is not having to deal with the day-to-day operations of active tenant management or property maintenance. Again, in the syndication structure, the general partner or general partners are responsible for the asset management. So again, once a syndicator has sourced a deal, done their due diligence, structured their investment, found investors and communicated appropriately with them, the job is to, of course, manage that asset, maintain that asset. A lot goes into that, but they oversee property operations, tenant maintenance, and other value add strategies. Finally, they help manage risk. So we'll talk about, what a good syndicator looks like. But one thing to look at when working with a new syndicator is what type of team they have around them. What type of underwriters, what type of risk analysts, what type of strategies and tools do they employ to mitigate risk? It's important. But that's their role. Part of their role, again, to mitigate the risk for their investors. Okay? So go over it again. The GP is the active investor. The LP is the passive investor. The entity, an LLC or limited partnership, typically owns the property. As simple as that. All right. So now we've talked about the role of the role of the GP, the general partner in a syndication. Let's talk about the actual decision-making or the syndication process for the limited partner. Now, again, the limited partner are all of you, right? And anybody that's joining us online potentially that wants to learn more about investing passively in multifamily. Well, the first step in that process is similar to the syndicator. It's deal sourcing. Now, it's not the same as the syndicator. You're not going out, scouring the market, driving for dollars, or doing anything associated to sourcing the actual property. Your job as a limited partner is to go out, identify and evaluate syndication opportunities. Typically, you do this through networking, referrals, engaging with syndicators and other investment activities. But that's how you'll find deals. And again, we'll talk about that a little bit more as we move on in the presentation. But deal sourcing. Once you've found a deal, your next step is to complete due diligence. Yes, you have your own due diligence to do. This may include learning more about the syndicator, their team, their company. How long have they been in business? How many syndications have they successfully raised capital for and exited? What are their returns for their investors? What type of tax advantages come with this particular real estate investment? And does it make sense for my particular portfolio? Now, once you've done your due diligence, you've talked to your CPA, you've talked to your attorney, you've identified that this is a good opportunity for you. Now you move on to your investment decision. Either yourself and your spouse, yourself and your CPA will all get together, put your heads together, and to decide whether or not this is a good opportunity for you. Once you've decided that it's a good opportunity for you and you want to move forward with making this investment, you'll complete what they call a subscription agreement and PPM. PPM stands for Private Placement Memorandum. Now, some investment sponsors have different documents, but generally the two documents that you will see and sign are the subscription agreement and PPM. The subscription agreement typically details the actual investment strategy, the opportunity, the property, your returns, the returns to those general partners, and all of the legal structure of this particular deal. It's usually about 100 pages. And we'll give you all of the details related to that particular investment. Again, that's part of that due diligence process, is reading those documents, making sure that you truly understand those documents, and you're taking into account that everything that's in there. But anyway, once you've done your due diligence, once you've made your buying decision and decided to move forward, then you would complete your subscription and legal documents. Once those legal documents are completed, you would then work on your capital contribution. Again, this is the most exciting part about investing through a self-directed IRA. With brokerages like Schwab, Fidelity, TD, you're limited to a menu of options. And these options typically include public securities, stocks, bonds, mutual funds. But your capital contributions can come right out of your IRA, right out of your IRA and 401k. How exciting is that? So anyway, once you've signed your legal paperwork, once you've committed to the deal, the next thing is to actually fund that deal. So sending your capital to the syndicator. Once your capital is with the syndicator, again, you are a passive investor. You sit back, you sip your umbrella drinks, and you watch money come to your mailbox every month. Isn't that great? Well, I wish. But in essence, that's what happens, right? Once you've committed to doing the deal, once you've sent your capital contribution, you are now a passive owner in a real estate syndication. You allow the general partners, the asset managers, to manage all of the day-to-day, and you sit back and receive dividends and distributions from rental income, appreciation, refinancing, and other forms of value-add strategies. As an owner, you receive ongoing communication and reporting from the syndicator. That goes back to the investor relations piece, right? Part of being a good syndicator is making sure that you have good investor relations, making sure that you're communicating appropriately and effectively with your investors, making sure that they feel heard, as well as that the deal is transparent for them. Distributions and exit strategies. This is the final step. The typical hold time for a real estate syndication is about 4 to 7 years. It's 4 to 7 years. Sorry, guys. It's 4 to 7 years, right? At that time, the syndicator, hopefully they've defined this well in advance, has an exit strategy. That exit strategy, again, can include refinancing the building and holding it for longer term. That can be divesting the asset, selling it outright. That can be a whole slew of opportunities. But of course, the end goal, the ultimate goal in any real estate opportunity is to ultimately receive distributions, so monthly income, regular recurring income, I should say, as well as have a strategy for exiting. So depending on how the structure of your deal is set up, how your syndication, how your fund, how your investment is set up, you will receive distributions in perpetuity, or at some point, your syndicator will divest that asset. You will receive back your principal returns, typically a preferred return. And depending on how well you guys did on this opportunity, maybe some more money as well. Now, identifying and evaluating multifamily investment opportunities, something we get asked all the time. Well, Steve, this is fantastic. I want to put my money in a syndication today. How do I find a syndicator to do business with? Well, the exciting thing is new technologies have made accessing these deals much easier. And we're a passive custodian. And although we work with multifamily operators and syndicators, we're unable to sell our clients on these investment opportunities. There are portals like Palace, Cashflow Portal, InvestNext that list offerings from syndicators, operators. You as an investor can sign up for these platforms, go and scour the marketplace, do your due diligence, and source deals that way. Another great way to source deals is networking. Most operators host what they call meetups. Meetups are local events They're typically small and intimate gatherings of 50 to 100 people, all there to learn a little bit more about investing in real estate. Usually, they're there to teach their investors about their deal, or talk to their investors rather about their deal, the type of returns that they may see, and the benefit to working with them. So meetups, networking events, real estate conferences are all great ways to source new deals. And once you find these deals, it's important again to do your due diligence. Part of that is evaluating the rental demand and the growth potential for this particular area. Now, again, that's some of the advantages and disadvantages to working a little bit more hands-off with these investments, but you always need to make sure that you're covering yourselves. And when making these decisions by yourself, it's important to consider those factors like rental demand, growth potential, etc. Assess market trends and economic indicators. Most information is public. PERE is a great place, privateequityrealestatenews.com. It's a great source for news on real estate. Marcus and Millichat, they publish news articles all the time on where we're at with the current real estate market, multifamily market, where the trends are, what markets are hot, and where we're going. Demographic factors also, of course, contribute to good deals and deals making sense for people. Analyzing those demographic factors before making your decision can be important in sourcing good deals. Now let's talk about what a good multifamily deal looks like. The first consideration is location. Is the property located in a growing market with strong economic fundamentals, job growth, and population outlook? Rental demand. A good multifamily opportunity will have rental demand. There'll be a high rental demand in the area. This could be due to a number of factors, including limiting housing supply, favorable demographics, proximity to amenities, and other employment centers like healthcare systems, or even schools like college campuses. Value add opportunity. I think this is a word that gets thrown around a lot, but this is a good thing in a multifamily deal. If the property has potential for value add strategies, such as renovating units, improving common areas, implementing cost saving measures to increase rental income and values. As I mentioned, working with an experienced syndicator is super important. So location, yes. Rental demand, yes. Value add opportunity, and of course, working with an experienced operator who not only has experience in going out and acquiring and finding these deals, but also managing those deals effectively. Conservative underwriting. Be cautious of the underwriting. Underwriting can tend to be a little bit overzealous. Make sure that your deal has conservative financial projections, right, that take into account a realistic assumption for rental growth. Super important. Risk mitigation. A good multifamily deal has had the proper due diligence, the proper underwriting, the proper deal sourcing done to ensure that risk management strategies are in place to mitigate the investor's risk. Investor alignment is also super important, making sure that your goals are aligned with those of the syndicator and the syndicate, the rest of the group. A bad multifamily deal is categorized by a weak market. So this may be a property located in a declining or oversaturated area. This may be a market with high vacancy rates, limited job growth, and unfavorable economic conditions. So almost the exact opposite of the property that we talked about before. Again, rental demand is another consideration, and a bad multifamily property will have low rental demand. A bad multifamily property will also have limited value add potential, may be operated by an inexperienced syndicator. As I talked about, aggressive underwriting, right? That is overly optimistic, can lead to the potential overvaluation and unrealistic return expectations. Unaddressed risk. As we mentioned, addressing the risk, doing your due diligence, making sure that your risk management systems are in place to not only limit your risk as a general partner, but those of your limited partners is crucial in maintaining a successful syndication. Furthermore, misaligned interests. They always say, go with your gut. Trust your gut. If you feel wrong about this deal, if you don't feel 100% sure that this is the deal for you, don't do it. Don't do it. All of these factors should be considered, but individually they're strong as well. So let's say, go back one slide. So we've got a great location, high rental demand. There's a bunch of potential to add value to this property. We're working with an experienced syndicator that's done this 10 times. We make sure our underwriting is conservative, investor returns are appropriate and reasonable, but our risk mitigation strategies are not in place. Or the actual goal and outcome, the exit strategy of this particular investment is not aligned with our goals and visions as a limited or passive partner. Walk away. It doesn't matter how good all of those are if they're not all good. For this to work, everything needs to be working in your favor. We've talked about building a diversified portfolio. Again, when you talk to your financial advisor, and traditionally when you think of public securities, you think of stocks, bonds, mutual funds, ways to keep my money in different buckets and making sure that all my eggs are not in one basket. Well, building a well-diversified portfolio in real estate is also important. It helps balance risk. It helps weather challenges of economic downturns, outmigration, you name it, and offers access to different strategies, possibly resulting in long-term wealth growth. There are 3 strategies for diversifying your real estate portfolio: geographic diversification, property type, and risk profile. Geographic diversification simply refers to making sure that your properties are located in different regions, cities, or neighborhoods, and make sure that you spread your risk across markets. You don't want to purchase into 4 syndication deals in Austin, Texas, when all of a sudden, a new wave of poverty hits Austin, Texas, and your entire portfolio is now enveloped in these deals. Make sure that you're spreading risk. Invest in Austin, invest in Charlotte, invest in Florida. Regardless, keep your risk spread by purchasing properties in different geographic locations. Again, consider factors like economic stability, population growth, job opportunities, and then also other market dynamics when selecting new markets. Property type diversification. We talked a lot about multifamily like apartment complexes, condos, right? But as I mentioned, there's other forms of commercial real estate that people syndicate for. Other forms of passive real estate investing. So some syndicators buy multifamily complexes, others purchase large blocks of single-family homes, office buildings, retail spaces, or industrial warehouse. Some are building self-storage centers. All of them operate on a similar model. There's a property, an entity is created to buy the property. There are general partners and there are limited partners, all pooling their capital for the common investment goal, which is to purchase that property. Whether it's a multifamily apartment asset, a condo, a self-storage center, a warehouse, an office, it doesn't matter. The structure is the same. Again, your returns, the actual waterfall and everything like that may vary, but the general structure that we outlined is the same. That said, I am not by any means telling you to put all of your money into multifamily and keep it there. Multifamily can be a great investment strategy for accelerating your retirement and getting involved in real estate. but so can self-storage, so can office space, so can other forms of commercial real estate. So make sure that you keep a diversified portfolio of other property types, not just multifamily. Diversification. This is kind of like what we talked about, the risk profile, right? We've talked about core properties, stable income, low risk, value add, right? Those with higher or moderate risk, other opportunistic investments that have greater rewards. Again, a lot of factors to consider there. Evaluate the risk factors, market volatility, property condition, lease terms, and then the tenant mix that's in these buildings. But yeah, geographic, property type, risk profile, making sure that you're purchasing into opportunities in other geographic locations, investing into property types that aren't just multifamily, so other forms of commercial, industrial, or mixed use properties, and then of course, mitigating that risk profile. Now, we've gotten to the end of our presentation, and I know at this point you're super excited to invest in real estate syndications using your self-directed IRA. Well, you now have the choice to retire well, and the process could not be easier. It only takes about 15 minutes to establish an account. Once the account is processed or the application is processed, that starts your 7-day right of rescission. Without getting too granular, it's a waiting period. But we as a custodian have to wait out before assisting our investors in placing any of their investments. Furthermore, you can use that time to actually get your account funded, get funds placed so that they're ready to go to make your investment once they're here. Finally, as a NuView client, you have access to our vast knowledge database and all of the resources and tools that we've provided and developed to educate our investors. Finally, determining your investment choices, making your decisions, using your knowledge as power versus the minds of many others. Today, you overpay for your IRA, draining your hard-earned money, exposing you to market volatility, causing you to pay excessive commissions and fees, while missing out on lucrative alternative offerings. So I ask today that you consider not just what we talked about, investing in multifamily, investing passively in real estate, but really considering your options to take control, to stop being victimized by the standard wealth system, to be empowered to make your own choices, lower the negative burden of taxes, and invest in what you know. Join us at NuView Trust to do just that. For those of you here in person, and for those of you joining online, scan our QR code, which will take you to our landing page, which outlines the steps for getting started. As I mentioned, working with NuView has never been easier. The first step in the process is to establish your account. You'll do that with an IRA application. The second step is to complete the funding information. So actually get your funds from wherever they're currently being custodied into NuView for the purpose of your investment. And then the third and final piece, once the account is open and the funds are here, is to place those funds into your investment through the help of our operations teams. So again, process is simple. It's as easy as 1, 2, 3. And if you're interested in learning more about it, give us a call and talk to one of our IRA specialists. For those interested in learning more, check us out on social media, Facebook, Twitter, LinkedIn, and catch us live every week for our educational classes. Thank you, everybody. Have a great day.